Hi, I'm Robin and I feature on today's episode. We just wanted to let you know that this episode was filmed prior to the release of the proposed changes on capital gains tax and negative gearing. For a detailed overview of what this means for property investment, head to momentumwealth.com.au and watch our dedicated webinar. Thank you.
For Season 3 of Property Investing Roadmap, we've flipped the script and asked listeners what questions they want the answers to about property investing. We've received questions across a wide range of topics, from how much money you need to start a property portfolio through to diversification and property strategy. Some of these questions deserve full episodes, which you're going to hear throughout the season. But in this episode, we're tackling a quick fire round of questions from clients and listeners. To help me work through them, I'm joined by Robin Ram, Department Manager of Property Advisory, Acquisition and Research at Momentum Wealth. Welcome, Robin.
Thank you, Damian. Thanks for having me.
Great to have you here. Now, I've got lots of questions to get through today. The first one we've got is, how much do interest rates actually affect residential property investment?
Definitely has a bearing. The ups, the downs of the interest rate affect affordability. They affect the holding costs for clients. So it does make a difference. However, we are looking for property investment at the long term. So what are the fundamentals of the property? Where's it going to be in 10 to 20 years time? So even though it has a bearing where it's going today, that only affects you today. It will go up, it will go down over time, but it's the right fundamentals that are crucial, not just where the interest rates are at.
Yeah. And look, we do see interest rates go up and down over the cycles, and they're going to do that forever in a day. They're going to keep going up and down. Yep. Do you think it sometimes depends on the strength of the market? So if the market's a bit soft and interest rates go up, maybe that might have more effect. But certainly over the journey, I've seen, I'm sure you have, when the market's really strong, it just doesn't seem to have any effect at all, does it?
That's right. The market being hugely dependent on supply and demand. If the supply and demand metrics are way off, it's just not going to make much of a bearing.
Yeah.
So it might remove 1-2% of buyers who really are stretched to a certain point, or it might mean someone might just hold off a decision for a little bit, but that decision being held off is generally only a week or two or a month, and then things go straight back to normal again. So same as elections, we just see it just holds for a little bit, and then people realise, I've got to make a decision anyway. It's still for the long term. I'm still going to make that.
I think the advice there is for a buyer, as long as you can afford the interest rate increase, and it's still going to be, means you can still afford that home or investment property, you've got to look through the noise, focus on the long term. During that 5-10 year period you're holding it, they're going to go up and down again anyway. So it's really about focusing on the long term, not what's going to happen to interest rates next quarter.
That's correct. And even where you're buying makes a difference. I remember, and it might be worth expanding on, Damian, the correlation between maybe east and west and affordability, how you've seen that in the past, what difference it makes that interest rates go up doesn't necessarily mean something's going to happen, because what can happen in Perth might be completely different than Melbourne, Sydney and Brisbane.
And that is actually a good segue into the next question. I'm thinking of buying an investment property. Should I be looking at Perth, Melbourne or somewhere else across the country? Where would we look? Thinking though, of course, not what's going to happen next week or next month, on a 5 to 10 year period. What's your thoughts on, maybe let's focus on the two big markets we spoke about there, Perth and Melbourne.
Yep.
What's your thoughts on those two?
I would straight away ask the client, how are you exposed to these marketplaces already? It's well worthwhile to diversify a little bit. Just because one marketplace is going up doesn't mean you need to put all your eggs in that one basket. So if you're already exposed to Melbourne with 3 investment properties, yes, it might be a great time to get into Perth. It might be a great time to get into Perth now if you haven't bought a property, see some of the growth that may come up, but then look at Melbourne in maybe 12 to 24 months' time. So where are you in your own property journey, and what are you looking to sort of offset over your 5, 10, 20 year journey? So when one market might be a bit softer, the other one's a bit stronger, and vice versa. So yeah, definitely starting back at how many properties they've got or where they're starting, and then what fundamental that marketplace is at. So Perth being a growth market, hypothetically, you might want to expose yourself there for the next 12 months. However, if you've already got one in Perth, it might be prudent to be looking at other states, potentially in Melbourne, to go, well, look, affordability is different here, different value for money with what I'm purchasing, and that might be my next move. So when Perth's had its run, Melbourne can then maybe continue on and take the growth while Perth slows down.
I think it's also, as well as the diversification angle, it's also looking at the fundamentals for the next 10 years. And both Melbourne and Perth have pretty strong population growth, so they're both ticking that. That's really important in property investment. The strength of the economies differs a little bit depending on where you're looking, but certainly in the mid-2020s as we sit here, it is a stronger economy in Perth and Western Australia than it is Melbourne. But the price relativity is that Melbourne seems to be cheaper at the moment. So I think for any investor, look at it as part of your diversification before you choose a city and focus on the next 5 to 10 years, not just the next 5 to 10 months.
Yes.
Great, Robert. On to the next one. A listener has asked, how do I compare different investment strategies? Should I buy and hold, renovate and flip, subdivide or develop, or just build to rent? Tell me about some of those strategies and what should an investor consider?
So a lot of people do come to see us with the idea of, I want to buy an investment property and my friends are doing this, I've heard I can do that, this is what I want to do. However, they haven't actually decided what they want to purchase for themselves, how much money they're going to put into that, how much work they may choose to want to do, how much money they're going to want to put in every month for their investment property as well. So when we're looking at different investment styles and different investment properties for clients, we want to make sure that fundamentally what you're going to purchase is aligned to strong investment fundamentals, but also something that you're willing to hold. If you get into something that isn't the right style of investment for you because it's costing you too much money and that's frustrating you, you're going to quickly decide, maybe this isn't for me, I don't want to spend more money on maintenance, or my tenancies turn over a little bit too often, and all of a sudden they forget what they were planning to do with that property for the long term. They've sold it too quickly and they just haven't made the money that they could have made. So we really want to work with clients on their risk tolerance. So where do you want to be in maybe 10, 20 years time? And then how can we align with your income, your strategy, your tolerance to want to do work and commit to this property as an owner and as a landlord, and then work from there to make sure they're buying the right asset?
I think a lot of those TV shows make renovating and developing property look really easy, and they're making a lot of money. But the reality is, from my experience, is seeing that people, when they're renovating and flipping, you generally got to get your hands dirty, right? If you're paying all the trades full market rates, with your stamp duty in, your sales costs out, and not only that, even if you make a profit, you've got to pay tax on it, and that's generally at full marginal tax rates. So most of the money in property is about the long-term hold, and that's our philosophy. And what we tell clients is that the most of more money is going to be making in the long-term hold. It's going to go up and down and sideways sometimes, but that's where you want to be. So yeah, they sound great, develop to sell. Even in the develop to sell, what I've seen out there, for every hugely successful developer who's made $100 million, there's been dozens and dozens gone by the wayside and gone sometimes bankrupt. So for most people, 98% of investors, the best way is buy and hold. You might add some value to that. You might develop something at the back to hold, or you might renovate to hold, but the focus should be long-term hold.
Yeah, most of our clients, when we're looking at that, it's renovate to hold. It's where can we find an asset that's not so attractive to the owner-occupier market, but is still very well located, that we can spend a minimal amount of money on, and we help our clients do this, where they might spend $20,000, give it a refresh, and then put it to market, get a good tenant in there, and then hold for the long term. Quite often that 20, 30 grand spent on a property makes a big difference in its saleability, in what tenants can move into the property. And then they've also got the benefit, they've just added a bit of value to that asset. So when they want to leverage that and go again, they've got some more equity in that property. So those are the opportunities we look out for, more so than what we've seen in the flip market is people trying to buy something that they can quickly get into, but they're not using the value of their own time in the equation. They're looking, I can buy it for this, I can do this, this and this, but then they quickly diminish how much time and commitment it's going to take for me to get that, and how long will that take, and where will the market be when I choose to sell that product. So those ones, because of the affordability issues right across Australia, the renovation and the flip style of properties are quite popular, and we've seen them going at prices where it just doesn't make sense for a normal person, and we're better off walking away from these ones and finding a better quality asset that just needs some minor work.
Great point, Robin. Now, the next question is, I'm thinking of buying an investment property, but I don't understand all the costs involved. Can you tell me some of the costs of owning an investment property?
Yes, as soon as you purchase that property, you've got the government share, so straight away stamp duty comes in. You're going to need to pick a solicitor conveyancer to work for you as well. There's also going to be some inspection costs. So when you're looking at those costs, those are the entry costs for your investment property. Once you've settled on that property, quite often it can be 1 to 3 weeks where your property may sit vacant looking for a tenant. So you've got to make sure it's priced realistically, but know you're not getting that sort of rental income. When you've then potentially got a tenant, you've moved in, you've had advertising costs, you've got leasing fees for property management companies, it might not be from anywhere from 1 to 3 months before you start seeing regular income come from your investment property. So it's really crucial that investors keep a buffer aside for once it's settled, they're not expecting a tenant straight away. but also to get the property ready for compliance. Every different state has different compliance rules, and it's quite common that you might need to spend $500, $300, $1,000 fixing a few things to get it ready according to the Tenancies Act for that state before you then lease it out. Once you've got that property, the ongoing costs are your council rates, your water rates, your maintenance costs, you've got property management fees in there, you've got land tax to consider as well. So these all eat into what it's going to cost you to own that. And then of course you're trying to deduct as much as you can along the way as well. The maintenance is also a big one to consider. Maintenance is one of the largest frustration points for investors who don't want to necessarily put in the $1,000 a year, the $3,000 a year it takes to maintain that asset. So they try to just delay it. And then all they end up doing is having a larger cost in 10 years' time, 20 years' time when the property's really tired and it's not attracting good tenants anymore and it needs that refresh in order to be in line with market.
And one of the things that's great about residential property is it's generally they're easier to lease and you don't have big vacancy periods compared to commercial. But the downsides are, as an investor, you've got to pay all those costs. In commercial, it's a different world. So It's about being prepared, as you mentioned there, right up front when you first get the property, those costs of buying, but also that initial period, getting the property ready. And we know some of the laws around the country, particularly in Victoria, probably one of the most difficult to deal with, all the compliance regimes. Other states all have them to some degree, so you've got to be prepared to get the property up to the standard it needs to be under the local laws, but also that vacancy period initially, leasing fees. But I always think putting aside that amount for maintenance. I know a lot of people just think it'll never happen and they put their head in the sand. But I think if you budget, and it depends on the property how much you want to budget, but if you budget $2,000 a year and you get a year where you don't have any maintenance, well, that's happy days. But next year, keep that $2,000 plus another $2,000 aside because you might get a hot water heater go. So it's just a matter of budgeting and planning, keeping that money aside mentally and not banking it and spending it because maintenance will happen eventually, won't it?
Yeah, and you will have to pay that cost eventually too. And most people prefer to stomach $2,000 a year than $20,000 in 10 years. So it's also a way that you can feel a bit better about your investment, making the ongoing claims that are there. And not only that, it shows your tenant that you care about your property. So many tenants will leave a property, and these are good tenants, because they feel that the owner doesn't want to spend money on their own assets. So if the owner doesn't respect their own property they've purchased, are the tenants potentially going to stop their kids from putting their hands on the walls as much, or just be a bit more gentle with that? Or are they going to care for the garden just as much when the owner doesn't seem to? So demonstrating respect for your own property passes on to that tenant as well, and you're more likely to keep them happier and want to stay there for longer.
Yeah. Now, speaking of rental properties and rental returns, the next question we've got is, what sort of yield should I be chasing on an investment property? Now, we know, Robin, of course, that'll vary in the cycles, but what sort of yield do people likely get on a gross yield first and then maybe a net yield on residential investment properties?
Really depends on which marketplace you're in. They differ significantly across Australia, from Darwin being the highest to some areas of New South Wales, particularly Sydney, being quite low. Even within marketplaces and cities, it can vary significantly. And I quite often show clients that this is an example of a very well producing capital growth area, and the yields are, let's say, 2%. Here is one that hasn't performed as well for capital growth. It might be, let's say, a 350, 400% growth over 30 years, but the yields are 5 to 6%. So some people come to us with an idea that I need to have a 5.5% yield. Yield is a reflection of risk. So yes, we can get you potentially that 5.5% yield, but what is that costing you on the other side of it? Where are you investing to get that? And what is that potentially doing to your capital growth? I'd be interested in your perspective as well, because I'm mindful of the regions and of course the rentability and the yields being so high. What would you say to clients if they're saying, look, I want to get a 9% yield or 11% yield, but it means I need to go to a regional mine in Queensland, a mining town, or a regional mining town in Western Australia, for example?
Well, I'd say that's not an investment, that's a speculative punt. And the reason, exactly as you said, the reason you get those higher yields is because of the higher perceived risk. Some of those mining towns, if you buy at the right stage of the cycle, properties double, triple in value. But also we've seen the other side where some people bought near the peak of the market in some of those mining towns, and when the mining bust hit, as it inevitably always will eventually, prices dropped 80%. So it's not, you can't compare apples and apples. What you're looking at is in a solid blue chip property in a major capital city. We're going to get maybe, depending on the cycle, 5% if we're lucky, but often 4%, or even, you mentioned Sydney, sometimes 3.5% gross yield. And then you got your costs on top of that, you're going to lose another 1.5% roughly. So you think, gee, Sydney, I'm only getting 2% net, maybe Melbourne and Perth and some other locations I might get 3 and a bit % net. But the whole thing is that's generally going to be a safer, nothing's risk-free, but safer asset in the long run, and it should continue to grow in value. It's not going to be as volatile as one of those regional properties. So our philosophy is buy the blue chip, buy the good quality assets. Maybe you might value add depending on your investor profile. But if you want to go to a mining town and get those yields, that's a speculation, not an investment.
Yep. So you might throw one in there in a portfolio of, let's say, 7 or 8 properties if you time it well, for example, and you understand what's driving that mining town and the longevity of that industry. I have done some property reviews for some clients where they've owned assets in regional Australia where they're getting 11% gross yields, which is excellent, but the property price hasn't moved in over 10 years. So the market fundamentals are not great for capital growth, but it's ticking a yield box in one area for the client, so they're quite happy with that, but it's not really enhancing their net value or their net worth. So maybe that 11% can offset a lower return on another property that you own in a Sydney or a Melbourne, for example, and that might be part of what your strategy is, but I'd be mindful to not just go straight for the yield, because yield is quite often the higher the yield, the higher the risk.
On to the next question. It's about diversification. So if I'm diversifying my property portfolio, should I buy fewer, better quality properties, or should I buy more lower priced properties? What's the choice there, and what are the trade-offs for an investor?
I would look at what are you willing to, I guess, what is your definition of success? When people come to us and they have an idea that I need to own 3 properties, like why do you need to own 3? Like why do you need to purchase them so quickly, and why is 3 the number? If you're owning 3 investment properties in the similar marketplace, is that going to outperform what another one really good quality asset could do? So an example I had with a client was he was a young guy and really wanted to hit 5 as his milestone. So his plan was all around, how do I get to 5 properties, Robin? And with his affordability, I said, look, I can get you 2 properties right now in a marketplace, but I probably wouldn't recommend it for you, but you'd be, at least 2 out of 5, so you'd be almost there to a degree. It's a great start. However, those 2 properties are worth the equivalent of 1 good property in the same marketplace. Now that 1 good property, if that goes up 10%, and hypothetically it's worth $1 million, that's $100,000 worth of increase. Those 2 properties worth $500,000. If that goes up 10%, that's still $100,000 worth of growth. But what you do is you're exposing yourself to 2 lots of tenants, 2 lots of property management fees, 2 lots of council rates, 2 lots of water rates, 2 lots of vacancy rates. And realistically, some of these ones that are further out at the $500,000 price mark will probably not do 10%, or if they do 10%, the one good quality asset might do that 12% or 11%. So they're actually saving costs, but they're buying a better quality asset with better long-term fundamentals, with most likely a better tenant that can afford longer increases in rent over time, will stay longer in that property. So it's around not just pursuing numbers, but pursuing quality, and then diversifying from that perspective to go, look, I don't want to be over committed to one marketplace only. It's a great place to start, but when I can afford to, I want to now go here, I want to go there. So I would say don't just focus on the numbers, focus on quality, focus on what you can tolerate for your own risk and your own personal attention you need to give to that asset, and then move from that to a position forward. Doesn't sound as great having 1 quality property over 2 to start the journey, but a couple of years down the track, you'd be quite happy that you bought that 1 quality one.
And I think it comes back then to understanding what you're actually buying for $500,000. Are you getting maybe $100,000 of land value and $400,000 of building value? Because that's not necessarily going to be a great investment in the long run, because simply as we know, the land goes up in value, the buildings go down. Yep. On the $1 million property, you might find it's 50-50. It might be 50% land value and 50% building value. So as you said, that might grow more in value. So I think that's something to be thinking about, not just the number of properties, it's what am I buying, the land component value versus the building value. And that's a really important measure. I think the other thing I'd say on that one too is the rental yields. Rental yields generally follow pretty equal. I mean, they diversify a little bit, but up to about the median house price in the capital city, they're fairly standard. There might be a little bit more yields at the lower price property simply because they're considered higher risk and poorer quality. But generally around that median price, in the quality, depending on the quality of the property, you're going to get a certain rental yield. But I think one of the things is when you start doubling the median price, the yields start to drop off. So a simple example, if the median price in a capital city is $1 million, you might get $900 a week for a rent, depending on where you are. But if the value of what you buy goes to $2 million, it's unlikely you're going to get $1,800 a week, or if you go to $3 million, it's unlikely you're going to get $2,700. So I think that's something to keep in mind. If you're buying up to the median and perhaps a little bit over, maybe that's probably the way to be rather than trying to go something half the median value. But if you've got enough money to go into, say, 3 times the median value, then it probably makes more sense to spread that around a bit more.
Yeah, most clients that come to see us when they're looking on, and they've got the serviceability, so if they're in a position enough to be able to buy multiple properties, and even though they could buy that $3 million asset, most of the property purchases for investment, we're looking for that blended mix of both. So we're looking for ones that tick the box for rental yield as well as good capital growth. So a bit of good of both rather than the extremes either end. So we're normally plus or minus 20% above where the median price point's at, and that's where a lot of investors choose to purchase.
Yep. Now, this one's, you need to put an accountant hat on, Robin. I know you're not an accountant, but this is, should I buy in my own name or use a trust or company to buy an investment property?
Well, knowing your background, Damian, I think you're the best one placed for this one.
Yeah, I'm a reformed accountant, although I still am a member of the Institute. Look, I guess there's a lot that goes into that. Firstly is when we're buying an investment property, most of us what we're doing is negative gearing. And so negative gearing means that the expenses after the debt are going to be more than our income, and we want to be able to offset that against our other income, whether that be salary income or whatever that might be. And so we get some level of tax back and tax refund. Now, you never get the whole amount back. Just to keep it simple, if you lost $10,000 on your property, the expenses are $10,000 more, and you are in the 47% tax bracket, well, you're going to get $4,700 back. You're still out of pocket $5,300. But that does help smooth that pain of negative cash flow, particularly if the property is growing in value 20, 30, 40 grand a year. That makes sense. Yep. But the issue is, for a lot of people, is if you buy a property in a company or trust, you can't access those negative gearing benefits. So if you're a business owner and you can move income around through trust distributions, then buying them in trusts generally will make sense because of the ability to, even if you have a loss in the trust, you can move profits in other entities, your business or whatever, through those trusts. So it's a bit of a complex area. So generally for salary earners, again, you need to go and see your own accountant, get your own individual advice from your accountant, but generally as salary earners, buying in your own name kind of makes more sense. Yeah. You just got to be careful about the other complexities, land tax aggregation. So if you're a couple, you might buy one in one partner's name, one in another, just so you don't get aggregated for land taxes. A lot goes into that. But if you're a business owner, perhaps you might consider those trusts, but go and get that particular advice. Now, one of the downsides of companies is you can't benefit from the capital gains discount. If you sell a property inside the company pays tax at either 25 cents or 30 cents. But if you take that out, you're in the top marginal tax bracket, you're going to pay 22 cents top up, or you're going to pay 17 cents depending on how much tax the company paid. If you own that property through a trust or a individual name, you get a capital gains discount. They discount the rate of capital gains on that. So there's a lot that goes into it, and there's no necessarily one perfect answer. It's one of those things that people need to go and seek their own independent advice from their accountant. And it may well be you start off individually in your own name, and then you may be able to buy them in another entity, depending on your circumstances. So I'd just say to that listener, go and talk to your accountant. There's a lot of complexity that goes into that, and the other important thing, as we've seen, Robin, is it's once you've got under contract, it's too late. You can't go in most states. I think there is one or two you can still do a nominee, but in most locations around the country, if you buy it in your own name and then the contract's done and dusted, signed, and you say, I don't want to put it into my company or trust, bang, you're going to get hit for double stamp duty. So Definitely. Just be really aware of that. Go and get that legal advice or your accounting advice before you buy a property, because once you put it under the contract, it's not easy to switch names and you might get hit twice for stamp duty. Yep. And we know how bad stamp duty is. No one wants to get hit for that much. So
it's slowing the process down. And if I can pick your brain as well, just on another question, which is I think relevant to where the market's headed and more inquiries coming through. I'm getting a lot of people that are wanting to purchase property in their self-managed super fund. I'm seeing that there's a lot of opportunity there for people, but there's also a lot of risks and misinformation. So if I could ask you, what would your advice be to someone buying in a self-managed super fund, and what do they need to be mindful of? Should they keep their money where it is? Is this a good option for them? And if it is, maybe what they should purchase.
So definitely I'll state this is not financial advice, and I'm not giving
Sorry to put you on the spot for that one.
Not giving advice on self-managed super funds. I guess, again, that's maybe where you need to go and talk to your financial advisor. if you got all property in your super fund, you got all property outside your super fund, maybe you want to think about some diversification. So personally for me, I've got a lot of property and a lot of property investments, but in my super fund, I've got a financial advisor and they're all in shares and other things like that, where they're the expert, I let them do that. So I think the first thing is to talk about diversification. Do you want to have all your eggs? You've probably got a home already, an investment property. Do you want to have all your eggs in one basket? So again, need to be thinking about that. And I think the other thing too is it's not that easy necessarily to borrow in self-managed super funds. It goes in ebbs and flows. We've seen over the journey when they first came out the ability to do that limited recourse borrowing. There was a number of lenders who did it, then they all seemed to nearly all drop out of the market. Some more have come back, and generally you pay a bit higher in the rate. So I think that's something else to be thinking about also. And while we're on the topic of that, even trusts, there's some lenders who have pulled out of it lending to trusts at varying stages of the cycle. So you just got to be aware of that. It's not just about the ability to borrow, it's about the diversification and also will you be able to get finance, because sometimes these lenders go in and out of markets and sometimes it's harder to get finance in structures other than your own name.
Thank you, Damian. I've seen just a lot of not necessarily great options packaged as amazing self-managed super fund options for investors, and a lot of times I look at them and I think, well, look, you're probably better off leaving your money in your superannuation than you are buying something that's that high risk, because if that doesn't perform well for you, you're really shortchanging your future. So, my guidance is going straight back to your accountant, but also make sure you plan it correctly and you don't buy on a whim. You don't buy something that is not going to perform or is driven by fundamentals that just aren't going to stack up in the long term, because you end up shooting yourself in the foot.
And we've got an expert coming in to talk about buying property and investing through a self-managed super fund. So everyone should look out for that one. That'll be hopefully coming out soon. Now, some other questions that we've got. There's a lot of people who can help people buy investment property. Can you tell me the difference between a buyer's agent and who does get paid and a property advisor who says they're helping you but maybe is not getting paid by you? What's the difference in their legal obligations, who they owe a duty of care to?
Well, I would look at who is basically, if I'm working for someone, who's paying me. So if the client's paying me, I've got a legal obligation to work in their best interest. If I'm being retained through a commission coming from a seller or a developer, it's going to change, and now my obligation really is to work for them and to get an outcome for them. So who's paying for the person? But then I would also look at when you're looking within an industry like buyer's agency, property acquisition, research, all of these things here, there's not necessarily training that goes with being a buyer's agent that you all of a sudden understand investment fundamentals. So if you're an investor and you hire a buyer's agent, what background does that buyer's agent actually have in property, and can they differentiate between a good and a bad investment? Do they have the data to support the decisions, or are they just saying this is a good one because it just makes sense to them? So it's important to know what you're getting into. The same thing is if you're using a buyer's agent for an owner-occupier purchase, the property's got to tick a lot more emotional boxes. It may be more area relevant where they need to live. So you do want someone who understands that marketplace and is operating in that marketplace that has those relationships for you. So there is a big degree of difference between people who just call themselves investment strategists working for builders or working for developers versus people who are working for you as an individual client. There are plenty of places that will work for you and that will do the job that you need and are paying for.
I think I read a quote recently, if you're getting something for free, you are the product. They're not giving you the product. Yeah, no, you look at social media, right? We're all on social media. That algorithm, all that stuff is there to get us to look at more ads because we are the product.
Yep.
And it's the same in property. If you're getting a property advice for free, nothing's free. Someone's paying that advisor and they're not acting in your best interest. You're the product and they're trying to get you to buy their product, their property from you.
And there's no such thing as a perfect investment. So if whoever's presenting a property to you is not talking to you about the positives and negatives and what you need to know about the whole investment, they're probably not giving you the full picture, and they might be pivoting you and packaging you into a product that's not suitable for you. It's just a product that they've got. So definitely you want to get information, you want a balanced opinion, you want to know the risks, you want to know the benefits.
Robin, appreciate your time today. There was a lot we unpacked. Hopefully our listeners got lots of value out of that. I look forward to seeing you on future episodes.
Thanks for having me. And as you said earlier, Damon, we can both talk the leg off a chair. So rapid fire is definitely a bit of a challenge, but we got through it, and hopefully there's a lot of value there.
Thanks to everyone who sent through their questions. We hope we've given you the answers you've been looking for. As always, if you've got any questions about property, please get in touch with us or your accountant or your advisor. We're really passionate about property and we love working with you to help you achieve your goals.